Right now. Hello, everybody. We are here for the Sofi Weekly 2022 wrap-up. We're late because our boy Tevis.
Hello, everybody.
Was at a fancy little dinner. So, Tevis, you want to tell us what happened at this dinner and why you're late for the podcast?
Yeah, I'm late because we do this on Friday night, and people
And you have a life? Is that what you're trying to say?
Stuff to do. Yeah, exactly. That's exactly what I'm saying. But
I went out too, man. I went out too. I got back on time.
All right. Jeez. Yeah, it was cool, man. It was like one of these dinners where it was like a sensory deprivation thing. So they put you in a pitch black room and they give you like mystery meals. So you can choose like an entree and then a main and then a dessert. And there's an option on the menu that says surprise me. And you can't see anything. And it's just like all blind waiters. So like they're like, hold on to my shoulder, and they'll walk you to your table and you're just like feeling everything in the room. And so, yeah, I sat in a pitch black room for like 2 hours.
So I think I know of the exact restaurant that you're talking about in Toronto. Because I only know of one famous restaurant like that.
Yeah.
I've never actually been there or know anything about it. How do you order? How do you see your menu?
So you order beforehand and you make your entire order, like starter, drink, main, and dessert all beforehand. And then they assign it to whatever your table is. And then you go, the waiter, and he drags you into the dark room. It's really cool. Yeah, you should try it.
Was the food any good?
The parts that actually made it to my mouth were very, very good. I feel like I scattered the food all over the table because I couldn't even see where it was.
That's hilarious.
Yeah.
So what if someone's vegetarian or something? And
there's vegetarian options, and then you give them your dietary preference ahead of time.
Interesting.
So you don't think you ate your whole plate, and you have no idea if you did or not?
I don't know. I got ice cream to end, and I was just like, I'm not sure. Like I was trying to feel the bottom of the anyways. It was
okay. So
yeah,
go ahead. Yeah, go ahead. Okay. Well, I was just gonna say, like, I don't know. Did you make a mess? Like I mean, that's such a weird experience. Did you find that the sensory deprivation meant any difference? Do you think? Oh, and also, do you think it was like, is it so pitch black where you really can't see anything, or is there a little bit of dim light, like maybe from an emergency exit sign or something?
So 0 lights at all, completely pitch black. Your eyes don't adjust to anything. I couldn't see literally here to there in front of me. How I found, you just take your time, right? You just really measure out, like you take your time. And then after a while, you sort of get acquainted with where you put everything, like where my glass was, where my plate was, and all that stuff. I don't think I made a mess, and I do think I had everything, but yeah, it was crazy. And the thing that's crazy to me is like they had 40 some odd tables, and they're all in different rooms of this experience. So like the main lobby obviously had lights and stuff where you like walk in and order, and there's like a bar and everything. But all of the waiters were blind or visually impaired. These guys, yeah. So you have a couple of hostesses that were like, they could see. And so they were like, oh, I have 2 people here for table 33. And he's like, okay. He's like, he would turn around. He's like, hold on to my shoulder. And then he would guide you to all the tables, which was actually insane when you think about how they do that.
I mean, literally, if they're all like visually impaired, that's how they, like, the room you're in is the room they're always in. You know, you know what I mean? Like
Exactly. So, it was. You should definitely try it, Tannor, and you know the place too in Toronto. So,
how much did you pay for dinner?
So it was like a fixed menu for the meals, and I think it was like 46, like 50 for basically like a starter, main, and dessert, and then the drink was extra.
So you could have bought 10 SoFi shares, but instead you decided to.
Yes, instead I had a life. I mean, yeah.
Guys, you don't get it. Mm-hmm. These stocks have declined so stupendously that it is at this point Byzantine to not make a rapturous life outside of stocks that have declined so dramatically. And so when you say you have a life, if your life doesn't revolve around spending every last cent on these stupendously declined stocks, then I don't think you actually have a life.
Yeah. Yeah.
I mean,
Well,
I put away like 80% of my take home, so I think I'm fine. I can
It's
live
not
on
enough.
20. I mean, I
It's
guess.
not enough. So not when you're flying to Qatar and going to the World Cup and doing
Yeah,
all the
that
things
was
they
also
do.
fun.
Yo, did you want Messi to win? Are you a big Messi fan?
I saw the game actually against Mexico, like Argentina and Mexico, and they won 2-0. That
Yeah.
was an insane experience. Um, yeah, I actually wanted him to win, right? Because it's like it's a culmination of this amazing career, and I think like this championship really was the final nail in the coffin for everybody who is like comparing him and Ronaldo on who is the best player ever. Because if he won the world, and like that was like the first time Argentina won in his lifetime, basically.
Yeah. Yeah. Okay.
okay.
Well,
We
yeah,
ready
go
to
ahead.
jump into some SoFi?
Yeah, we've got SoFi weekly end of year special. A lot of stuff happened this year. Riley couldn't make it today because he is out on vacation. So we are going to be recapping everything that happened with SoFi. Not really talking about the stock as much as more so going through what they did this year, how did they grow, and what we think could happen in 2023. So Tanner's got a little presentation. You can pull it
So,
up.
well, first, before I get into that, I want to build a little hype around that because it's going to be very, very exciting. I think it'll be the meat and potatoes of the actual thing. But let's first talk about Bender 9000 for a second. So, Bender 9000 is I don't know, a commenter, a researcher on Reddit. He goes over a couple different companies, but the ones that we have, that we share in common is SoFi. And he does a lot of deep dives to the point where people think he's an insider, Noto himself on an alt account, crazy things like this. However, I don't necessarily think that he's Noto himself, and I'll show you guys why. But he does absolutely share, some amazing things. So first off, let me just share this quick picture. Actually, wait, if it's not sharing properly, I don't want to. Can you see it, Amit? Does it look like you're seeing?
Yeah, I saw it. I saw it when you shared it.
Can you see this?
Yep. There you go.
Okay, so these were Bender 9000's 2022 predictions. This was back, in December of 2021, what he had predicted to come true. So that we would close out on a bank charter, we would get student loans back up and running, buy now, pay later, Super Bowl being the largest, marketing campaign for us. And these are the ones that he actually got correct in his assumptions versus the ones that he didn't quite nail. Okay, so the ones that he missed, first of all, because maybe we should talk about that. Student loans never came back in 2022. We did not launch SoFi Singapore. However, we do actually have a securities license there. So it's expected that we're going to be launching a SoFi Singapore, similar to how we have SoFi Hong Kong. Same thing for the United Arab Emirates. They think that there's going to be a SoFi UAE. We have a lot of career postings there, many engineers out there, but there is no app just yet. So he was expecting that in 2022, but that hasn't quite happened yet. Social invest platform to restart that in 2022 never really happened. There wasn't an official launch of anything crazy. Securities income program, very similar to what Robinhood has, just allowing you to sort of collect a dividend to lend out your stocks that way. IPO investing. It's not that we don't have IPO investing. There just really was no big launches like Bender 9000 had predicted, and we still don't have a SoFi tax filing. Anything that you guys want to say about Bender 9000? I mean, he had an almost 70% success rate on last year's, and then I'll tell you guys what his predictions are for 2023.
So actually, some of these in 2022, now that I look at it, he's carried over into 2023.
Right.
Which we'll go into it, but it's interesting to see the ones that he had for 2022 and how those have also carried over.
Right. And so it is crazy how, a lot of these things that he did very well. And I mean, some of them are just titled SoFi Stadium, and obviously there's more to it than that. But obviously, this is just a quick snapshot. If you want to actually go check him out, go see his Reddit page. Bender 9000 obviously is his user, but yeah.
The-
As I bring
the-
up this, yeah, just give me a second to bring up the next year's, but I know that both Tevis and I both made videos on it.
When they said IPO investing, did he mean that SoFi will let you invest in different IPOs?
Mhm.
Like, kind of like be on the waiting list and stuff like that.
Yeah, so there was a couple of them. Help me remember. I know Rivian was one of them. We gave people, if I believe, early access to invest in IPOs to get them a little bit of a better price. You know, a sort of a fundraiser for it, a pre-sale. And we revolutionized that. We were pioneers of that product. Now there's many brokerages that actually do it, but you know, I think he was hoping that the market wouldn't have declined so much that maybe, you know, there would have been new IPOs, like a potential like Stripe, for example. But it never actually happened. There's barely any companies that went public this year because it was a crap show. So obviously he's wrong in the fact that happened, but you know, obviously he's wrong. Like it's really hard to predict that that's going to happen.
You know how 2021 was definitely the top? Nerd's Wallet went public at $18 a share. If you guys don't know what this company is, they're a blog.
I didn't know they were public. I know of them.
They were freaking bro. I'm gonna look at the stock right now. I think it's like $4.
Didn't BuzzFeed also SPAC this year?
BuzzFeed SPAC as well. It's at $9, so it's down 50. But at one point it was $4. Yeah, I mean, I think Forbes also SPAC'd. Yeah, when finance blogs are going public, I mean, like, there's a lot of traffic, but like, it's just a blog. Like at the end of the day.
Yeah. No, I mean, it's crazy. I mean, if they do a lot of business, it doesn't matter how big they are, right? So any company can get like, you know, any company can really go public as long as they have their accounting in order. But what I find is really exciting is that they're giving you access to IPO investing in large companies. You know what I mean? Like Rivian was a very hot IPO, whether it was warranted or not. It was extremely hot.
Yeah.
You know, and so it's not really SoFi's fault. We still have that in our playbook. We'll be able to launch it whenever IPOs do come out, but there was just nothing hot this year. So yeah, it was whatever. Yeah, Tevis, what did tell me what you did in for Bender 9000's video?
Basically the same as you, man. I just covered the Reddit post, and then but I paired it with the post that I made last week on like everything SoFi did in 2022. And I guess in this episode we can talk more about like if we have specific predictions or chat back and forth on some of the points that Bender had, because in mine I was just mostly covering what those points were and not so much including my own opinions on how feasible I do think or don't that it's going to be. But
right.
Much it.
Having a hard time bringing this up. That's my only okay, I think I have it actually.
So before we go into that, do we want to just recap like what 2022 was, and then we can go into 2023 and like keep the majority of the episode there?
Yeah, sure. I did create a presentation if you guys want. It's not covering just 2022. So if we're looking for that, I mean, maybe there's some other things. I wanted to look at SoFi as a whole, just because, the stock has been a little bit in the dumps. And I just wanted to give people a little bit of a refresher on how SoFi has been growing from the earliest filings that I could find to today, because that's how I see the company, right? Is in a long-term vision. And so I kind of wanted to do a little bit of that if you guys are wanting to do that as well.
Yeah, let's do it.
Do you want me to jump into that already? We'll jump right in.
Let's do it.
All right.
BuzzFeed is 69 cents right now. Wow.
Jeez.
Well done. If you guys have any comments in the chat, any things you guys want us to discuss as well, let us know. And we will go through it.
Okay.
All right.
Here we go. Guys, this is the presentation. Let's look at SoFi. We're going to look at their member growth. We're going to look at their numbers. We're going to look at everything from Q2 of 2020 to Q3 of 2022. Because obviously I'd love to do a full year recap, but it's hard to do that without Q4, right? Like that's sort of a main part of this. So hopefully, in either January or February, whenever we get that release, that we'll see those numbers. First, let's talk about members. I mean, it's contentious on whether you want to talk about whether these are still daily active users, monthly active users, whatever. I mean, it is a cumulative number, but still, we have seen almost 300% growth in our members in the last 2 years and 1 quarter. Products grew even faster than that, 300 and nearly 40%. Lending up almost 50%. Financial services up 655%. And our tech platform, after we bought Galileo Technisys, is up 245%. Anything on the total numbers here for products?
I mean, it's a growth stock.
It's a growth stock.
Interesting that you did last 2 years, because you sort of covered, the boom and bust of the whole COVID wave.
Well, this is you can't get numbers earlier than Q2 of 2020. I mean, if you can find them, great, but I cannot find a single filing that's earlier than Q2 of 2020.
Got it.
I'm going all the way back from the 10 Qs of Q2 of 2021, whenever we went public, and then using their previous year-over-year data. So I'm going to the latest Q, 10Q, and then getting the year before that, which just sort of gives us the longest picture that we can see, because these are the types of things that I like to look at. I mean, any stock quarter over quarter can have bad quarters, good quarters. You look at Apple, it happens all the time. Whenever you zoom out and actually look at the company in general, investing has to be long-term. Okay. I don't want to look at the finances just yet. Whenever we look at the individual products, like you can obviously see, a couple things already stand out. Personal loans, large amounts of growth. Home loans, actually, surprisingly, large growth. Student loans, you'll see how, although there is growth, it doesn't look this pretty over this amount of time. We'll actually correct that. But SoFi Money, SoFi Invest, all unbelievable growth, 800%, 530%. Credit cards and referred loans, which is Pagaya, are both new, so they didn't actually have anything before this, okay? And then, Relay and Atwork, obviously just growing at insane rates again, 600 and 750% respectively. So just unbelievable growth. This is just products, though. This is not finances. We're going to look at the finances. But whenever you're talking about the actual, how many members can we actually go after and try to monetize, that number is going up dramatically, okay? Then, whenever we start looking at the finances, just the first little snippet here, okay, I wanted to just look at net revenues, net incomes, the ratios between them, and then adjusted EBITDA, okay? Now, this is for Q3. I wanted to highlight this. Q2, the numbers made zero sense to me. I actually think they were faulty. They said that we were, I didn't know if it was maybe because of the public numbers or something, but they were so far off from what I could see. We were profitable. We were doing all these sorts of things. And then it just looks like it's completely out of whack. So I don't want to just, I could be taking speculative numbers or whatever. I just wanted to show this because it's a little bit more on curve than actually showing something that is nowhere in this sort of, general vicinity. It's way off the chart. Anyway, net revenues up 111%, and the net losses are actually increased by 73%. Obviously not great, but this ratio is here to show you that we are closer to profitability. Once we hit 100%, that's profitable. And then everything after that is actual gains, right? And then we start to pay taxes. Adjusted EBITDA is growing, which is absolutely great. But now, obviously, that's supposed to happen. We have a bank charter, and that's going to continue to grow, and at a pretty good clip until everything is actually, gone through the bank, and we're starting to get those everything done, which is going to take another probably like 2-3 quarters to actually finalize. Okay, let's jump into actual student loans and see all the different finances that we can look at here. I know it's a lot. I tried to reduce it down to as little of statistics that still get you a good picture for what's going on. Okay, it's bad for student loans. It's bad, guys. Okay, origination volume shot down 42%. The FICO scores about the same. Not really a change there. I didn't put a growth percentage on negative or positive for FICOs because it just doesn't matter. Like, for example, if a FICO is 900 and you reduce it by 50, it goes down to 450. That's not a 50% decline, right? You can't go from a perfect credit score down to 450 and that be a 50%. It'll be like, nearly 100% decline. So It doesn't really work that way. So let's reduce, the percentage used. But average interest rate used or average interest rate earned down 14%. The income recognized has grown because we're holding more on our actual books. And you can see that because the sale of loans is way down, right? 90% decrease. Defaults are climbing 0.1%. Total weighted average. This is the amount that it actually makes up for our loan department for SoFi. So before we were dependent on student loans by 46.55%. Now that's reduced to 25.9%. Okay, a 44% decrease on our dependency for student loans. Our I don't want to show you guys that just yet. Average loan balance for student loans obviously decreasing because people are paying off their loans and we're not getting new loans back. So it's just, decreasing, obviously. And then potential interest is a calculation to show how beneficial our loans are depending on whether we're going to sell them or hold them. So this is factoring in everything from default rates to, the loan balances to the interest rate earned. So our student loan value is actually decreasing over time. Not great. Okay. So yeah. Any questions? Like any comments? What are you guys seeing?
Sorry, my thing was on mute. So the student loans that you're saying is looking bad for us. What is the metric you're using to like have that tone in your voice for why it's that bad for us?
What do you mean exactly? Like
well, so you're
not
saying student loans
any
are
new loans. We're only really losing loans because they're still on hold.
But so I guess my question is, why is it that bad for us if like we had a year without it, we still are able to grow? I mean, obviously it's not good, but if we're not really factoring it into our projections, is it really that bad or is it just not a net positive?
Well, here's the thing is that SoFi was back and forth on this. They said they were not factoring in student loans into some of their quarters, and now they are. Like Q4, for example, our upcoming quarter did factor in student loans coming in at the tail end of the quarter. Now they're not coming. So we're almost expecting a underperformance on our next quarter because of student loans not being there. So if SoFi does outperform, it's going to be a party on Wall Street. I'm telling you, or at least that's what I'm suspecting, because for the back half of the entire quarter, we were pricing in loans. So it's not necessarily a bad thing totally, but it just sucks. It was a large portion of our business, 46%, and it stopped growing for the longest time. These percentages, they tell a pretty clear story. You know what I mean? The only thing that rose on this entire thing was default rates. That's not the metric you want to grow. So yeah. But
yeah, I think like at the highest level possible, just for the sake of zooming out, yes, it's bad, and a lot of those metrics sort of point to that direction, but it's also, despite being our biggest business segment, it's still just one business segment in a very diverse business, which I think 2022 has shown us how diverse this business is with a lot of the new products that they've been launching. And so that's the sort of grain of salt that I'm taking this with. It's like, yes, they're declining, but at the same time, this is a slice of that full picture.
Right. And so I will even show you guys, I added this into the presentation as well, all the diversification and everything. So I'll be able to show you guys a little sneak peek into that as well. So that'll be a lot of fun. Let's move on to some home loans. Our entire home loan business down on this section right here, origination volume absolutely shot. Our FICOs, once again, they're lowering. They're still in great ranges, but I can't show a percentage for that because it just wouldn't make any sense. But our interest rate earned is growing like crazy. And this is only on the last couple of quarters that we're actually seeing because the Fed rates are really high right now. So, the home loans have risen a lot. And that means that our interest that we're taking home from our home loans is going up a ton. That's very, very exciting. Because we're a bank now, we're holding all the loans on our book. So, there hasn't been a large amount of sales. This is just specifically in the quarter of Q3 2022, but just wanted to show that. Default rates stayed, stagnant, awesome. And total weighted average for home loans has climbed a ton, obviously, because of those, interest rates. We're earning a lot more, went from 600 to, 600,000 to 1.5 million is what it should be. That's money in thousands. And then obviously the amount of money in the average loan balance, I mean, that is as equal as it gets. All of this leads to a potential interest. Like I said before, the quality of the loans. This shows how much we could sell these loans for. Obviously not that number, but the ratio of increase does show that these loans are more valuable to investors because default rates did not climb, but the actual interest rate did climb a ton. So it's more interesting to investors to buy these loans from us, but it's also more interesting as a loan for us to keep it on our balance sheet. So both absolutely amazing. A ton of potential interest that's actually increased, which is a metric that I like to look at to see, how valuable truly are our loans. Any comments? Again,
I expected it to be worse, honestly. With the interest rate environment being where it is, like student loans obviously had the moratorium, and then home loans just had the macro. Obviously, we're going to see a very different picture when we scroll down and probably see personal loans, for the next year. But I expected it to be worse personally. It's muddy, but it's mixed.
Right. It's because we're holding more loans on our balance sheet, I think, that we're taking in a lot more interest income, which I think is, makes it a little bit easier for us. But it's just the writing of new loans. This is the problem, and where they just say that our partners for our home loans are just not succeeding the way that we thought they would. So that's a big problem. Hopefully, like even Bender 9000 said in his predictions that we'll get to for 2023, is that's actually vertically integrating with a home loan business where we can actually write these things ourselves instead of worrying about a partner business, right? Now, whether or not that's going to be another acquisition or, whether that's an all stock deal, all cash deal, I don't know which one I'd want more. I'm not excited about either one of those. I want the cash to survive and I want the stock to not go down.
Yeah, and the other point I'll add on that, just an FYI for everyone, I do believe, Tannor, you can keep me honest on this, but I do believe in terms of products and in terms of originations, home loans is our smallest lending segment product.
Yeah. That's exactly, this is what the total weighted average is for. So, you look at student loans, makes up 25.9% of our total lending business. Home loans makes up 8.8%, but that's up from, these last 2 years from 3.85%. So it is growing in terms of how much we need it. And considering that the default rates are not climbing, I mean, it is a pretty exciting product. But I mean, it's mortgages, and who doesn't pay their mortgage, right? The old Michael Burry film. I forget what that is.
Big Short.
Let's go on to personal loans. Okay. Personal loans. Origination volume speaks for itself. So we were not a student loan business back in the day, really. I mean, actually, that's actually not true. It's still made up for nearly 50% of our overall business. Now it makes up 65% of a much larger business, going from 450,000 roughly to 2.8 billion. Sorry, 450 million to 2.8 billion, because the money is in the thousands here. So that's 525% increase. FICO scores are lower, but still very much within our margins. Our average interest rate earned is up, okay, and a lot. That's very, very exciting. Up 17%, okay. Interest income recognized is incredible, up almost 220%. This is also because we're a bank now. We're holding these loans longer, and we're also selling a lot of loans too. We're also funding a lot of our new projects, funding more growth for our loans through selling, a ton of loans here. Now, if I actually look on a quarter over quarter basis, if I remember correctly, it wasn't nearly as much that we sold from last quarter, but still looking all the way back from then, it's a massive increase, 263%. Default rates have been climbing from this point. This is sort of what the bears are saying is sort of the problem here, is that, we've increased our defaults by 0.8%. Now, my counter to that is that we also increased this, the interest rate earned by 1.8%. Okay. So that's the very exciting thing, is that for every loan that we lose, we're getting that money to pay for those losses. So hopefully that those interest rate earned will be able to obviously fund the unsecured part of our loans, right? And then obviously, like I said, we're now dependent on personal loans by 65%. And the actual balance of the loans are getting larger. This is also helping with the amount of interest earned. And then the potential interest. This is factoring in the increased amount of interest rates, the default rates, the total weighted averages, everything like this, or well, not total weighted averages. Loan balance, it's skyrocketing, going way up, 106.7%. Very, very exciting. Okay. Let's look. Okay. Do we actually want to say anything first of all for personal loans? Then we'll get into our financial sector, our technology sector.
No, I think I'm good.
Boys, you sound tired today.
This is a lot. No, these are good numbers. It's just a lot of numbers to digest. But
right.
It's exciting. It's exciting to see what it can become.
This is our financial services. Okay. That speaks for itself. This was not the same business 2 years ago, obviously. It's a very new product back then. We 10x the business practically. I mean, well, not totally, but very close to it. These are unbelievable growth rates. And I'll show you, because this sounds like a small portion of our business, but I'll show you how much that's changing and very, very quickly going on in the next one. So
do you think that's sustainable, these growth rates?
Well, I think not these growth rates. I think that we're still looking to keep up a 150 or 200% CAGR going forward. So I do think that there is a large growth rate that's still going forward. Our money products, our invest products are still by far our fastest growing products. And so I do think that this will be the fastest growing industry. I don't know if it'll keep up these growth rates. These were, some incredible changes, but yeah.
Yeah.
Technology platform. Actually, I don't want to get just into the next numbers. Oops. All right. Technology services. This is Galileo at its infancy to Galileo to where it is today. But we owned Galileo back then, right? So these are the numbers that they were putting up whenever we bought it for $1 billion, $1.2 billion. Now it's putting up numbers closer to these. I mean, this is also factoring in Technesis, but Technesis is tiny. I mean, really, really small. This is not only Technesis's business, but the software licenses is not Galileo. That's Technesis. It's a joke. Payment networks, this fluctuates like nothing you've ever seen. I mean, one quarter it'll be 600, the next it's 100, and back and forth, back and forth. So I wouldn't trust these numbers, too closely. Overall, though, this business has 4x'd itself in the past, 2 years. All right. Now, I wanted to do this one for you guys. I hope that this is a little bit more intriguing for you. What I'm looking at here is the total potential interest for all the loans and everything that we've looked at. So our total loan value in terms of how much more exciting it is for us to hold the loans or even sell the loans, technically should be 57% more exciting, but that's without factoring in how much it costs us to fund these loans. So I did a little research and looked at warehouse facilities, warehouse interests, how much we've changed during that time. And then also deposits. We didn't have deposits back then. We do now. These are interest paying deposits, and how much we're actually paying for those deposits. So we're paying, 2.9% for our warehouse facilities, 1.5% for our deposits. And that means that the difference in how much we're actually taking to fund these loans has increased by, 95%. Okay. But factoring that all in, including loan loss ratios or loan loss provisions of what we're looking at, our loans technically, including everything, has gotten better by just about 4% between that time and this time. Now, obviously, the total book value of how much loans we're holding has increased dramatically. So the fact that we're even increasing on the loans is a pretty interesting story. I'm just going to dive right into this next part. Obviously, there's this sheet here. Just want to get rid of this for you guys. This over here is Q2 of 2020, the side that I was showing you guys. And then on this side, it's Q3 of 2022. So this earliest filing that I could find are diversification. So financial services, 2%, 14% for technology services. This is revenues, okay? Lending makes up 83.6%. On the other side, we have where we are today. Not today, because we need the new filing to come out, which, I mean, the last day of Sofi's business is tomorrow for Q4. But this shows a pretty interesting story about our diversification. Our financial services has exploded during this time, most in recent quarters, and hopefully looking to continue. Technology services has grown, and the lending, our dependency on our lending department is shrinking. So this is what I talk about with Chris's sort of, or any bear really, if that, our
We can
this
call
is-
Chris out. It's okay to call him out. It's his
well,
case.
it's just the only one that we've had on the channel, right? So
Yeah.
this idea that if things are going to get worse, that we're too dependent on lending. And I mean, 69% is a lot. It's still very, very dependent, but it is getting a lot better. So this is what I mean, that the longer that this takes, this doom and gloom to happen, the hopefully the safer that we are, because by 2025, the idea is that SoFi is going to be a 30-30-30 split, right? Technology services, financial services, lending, and we will be very diversified.
The technology is that just Galileo revenue from that, or does that include something else?
And Technisys.
Technology is
Okay.
Galileo and Technisys.
Okay, got you.
Yeah, I think like just thinking about this longer term, I mean, I guess my whole thesis is that financial services is really going to become the cross-selling flywheel hub, right? And so I think 30-30-30 is definitely there from a dollar, percentage wise, but from a product origination perspective, I want to see financial services start to eclipse some of these other cohorts because of that cross-selling. But obviously dollar amounts are going to be, lending heavy because you're having huge loans like student loans, mortgages, stuff like that. But for me, let's say I have one mortgage or one student loan, but I might have 3 or 4 or 5 different products, which is where I see from an origination perspective, financial services being larger.
It's I don't even know. I don't know. It's very, very exciting to see that, our start of the flywheel, the top of the funnel, has grown so much on a revenue basis alone. Because it's not even supposed to be the revenue side, or at least it shouldn't be the profit side. I guess revenues is part of it, but it's really to send people down to this side. And
look, one thing I will add to that, just like as a devil's advocate, is that one thing that contributed to this 83 to 69 is student loans being kneecapped for so long. But the other side of that is that that's been counteracted with personal loans receiving this huge lift from the Fed, basically. So you could argue sort of both sides.
Right. Now, why don't we look at, because I know there's a lot of people, people that I've definitely spoken to that have bought in this stock back whenever it had IPO'd, right? People are SPAC'd, but IPOE or whatever it was called. So what was the market cap back then, and where are we today versus all of these statistics that I showed you? The large personal loan growth, the large financial services growth, the technology growth. And, I think people are worried about the recent term of the technology services, but don't give it enough credit for what it's done, during the pandemic era, where it's just exploding with new contracts. Right now it's not a very popular thing for neobanks to come out and, there was a flurry of new online banks or online financial or tech services, right? They weren't actually banks. There's very, very few. But, we were getting contract after contract. Now, what we're trying to do is go after the big guys. So hopefully we're going to see an explosion in technology services. I'm not going to believe it. I'm going to be pessimistic with how many actual contracts that we get. Once I see even one great contract, like Palantir getting the US Army contract, then I know that it's a very serious product. But I would take it at face value, or not face value. I'd take it with a grain of salt, knowing that Noto says that this is the best product in the world. Find me a CEO that says that their product's not the best product in the world. You know what I mean? So, but I just want to show you guys the difference in the market caps here of the business. At the time that we went public, it was $21 billion. Today it's $4 billion.
Wow.
Q3 2022 was $4 billion. An 81% decrease. I think that there were some numbers on there that didn't look great. I think there's some numbers in there that look phenomenal. I don't think it's an 81% decrease. And now I got to give a shout out to Chris Hager that showed an amazing tweet thread today. I don't find he does enough threads. So hopefully that's a little bit of compliment for him to do more of these, where he showed off that this is not a SoFi only, collapse in the stock market for fintechs. This is across the board. Every company, including, Warren Buffett's companies like Ally Financial and Nubank, are dropping like crazy. So is it a macro environment? Is the entire industry destroyed? Or, is it just a rebalancing? Very weird things can happen in public markets, So I don't know. I'm staying strong. Whenever I start to see the numbers change for SoFi, I'll be the first ones, to ring the alarm bells. But for now, I see great things, and I'm confident to keep investing. And I feel like, what's the difference between this and whenever Amazon dropped 90%? They were showing great numbers. The CEO came out and gave a strong letter. Now, I think that's something that Anthony Noto needs to do. He's not being loud enough. Here, let me drop this off. I think we're done with this. Anthony Noto's not being loud enough about the love for his company, except he's putting his money where his mouth is, right? And maybe that's even stronger than a shareholder letter. I mean, maybe it is, but
I would rather have that than a shareholder letter. Yes, because I've had a lot of Alex Karp shareholder letters that I love them. They're philosophical, but he's not buying shares.
Yeah, I feel like that's an interesting thing to touch on that I haven't thought about before, but it's also like this old school versus new school communication with your shareholders, right? Like you have the Warren Buffett and Jeff Bezos, who for years, I mean, they've made full-on books that compile all of the shareholder letters of these, like Warren Buffett and Jeff Bezos are the two I'm thinking about. And then you have CEOs like Elon or Anthony Noto that just mostly communicate through Twitter to their shareholder base, and it's more direct. It's more sort of off the cuff, and it's more frequent than a shareholder letter, which I guess if you take it at face value, it might just sort of signal this like old school versus new school way of communicating with your investors, and also like what is your investor base in general? Like, do you have mostly the retails or mostly institutions? But I kind of prefer the more frequent touch points as opposed to like one big shareholder letter, which is like I have to read between the lines to see if there's something hidden in between. Whereas I could just have a CEO that's just constantly tweeting out like, oh, new version of this will be out by midnight or whatever it is.
Right.
So Tannor, how much revenue are we gonna pull in 2022?
Well,
Expected.
I think the current estimates, if I remember correctly, is 1.52 billion.
And do you know how much revenue we brought in 2020?
I could do a rough look. Yeah.
The reason I'm asking is because obviously the whole stock market has declined, but 21 billion seems kind of ridiculous.
So 2020
was it ridiculous? Was it a chamath pump? Like
adjusted net revenue, Amit, we did about 621 million in 2020, and our guidance for this year is 1.52 billion. Trailing 12 months, as of our last report on Q3, we were at about 1.37 billion.
Now I didn't invest in this company during the IPO. I never bought at very high prices. I think the earliest I bought was $14.40 or something like this. And on the way down, not on the way up. And I even think, I probably bought too high. Like it was a market of free money. And, the Rivian IPO during that time. And I think they, if I remember correctly, they had, I could be butchering this. So Rivian investors, please correct me. But I think they had not actually manufactured a car for production at that time. And yet they were worth like $100 billion or something that something got ran up to. I mean, it was an insane story. So, were we overvalued at that time? Yes, that's what happens in very frantic markets. I'm not saying that, necessarily I'm trying to justify that market cap back then. I don't think that's true. I can only speak for today. Is it still worth me holding today? Right. And I think the numbers show, yes, I can only look at this company in as many different ways that I can possibly see. Okay, what's website traffic? What are these things? Can I compare it to its competitors? Can I look at its finances? Can I look at their product growth? I'm trying to look at it in every single way I can. And in no way do I find it justifies a $4 billion market cap. And then, sorry, go ahead, Tevis.
Yeah, I was just going to say, like, there was a duality because people by and large, the market wasn't investing on valuations alone, like Lucid, Rivian, what was the other one? Nikola, Charge Point, or like all of these ones were all story-based investments. And when you invest in the story, then you can very easily decouple the valuation today and say, hey, look, whatever, this company is not going to make revenue until 2024, but when they do. And so that's how you got to some of these crazy valuations. And now when times are, tougher, you have a lot of people over indexing on the valuation metrics, like the value investing.
100%, 100%. And it, like Ray Dalio said, to win in investing, you kind of have to be a contrarian player. So was I right on SoFi as it was falling down? No, right? That was a mistake. Do I think I'm right now buying it at this valuation? Obviously I do, because I'm investing in it, right? And but I can't see of a reason that justifies this valuation. So I have to be a contrarian here, buy the stocks that are depressed and wait for it to go up. And that's just not the way retail investors like to buy. They like to buy, whenever their friends bought a stock, and they like to buy Tesla whenever it was all the way jacked up into the sky. But now that they're having now that they're actually in the green, the stock is going back to where it was pre-pandemic. And yet people are scared of it now. Is this the end of EVs? It's the same thing as this. Is cash going to go more digital or less digital? Are we going to go back to swapping paper money? I disagree. I think more people are going to be, trusting banking, going online, especially as products get better. And SoFi's product is, whether you like it or not, it's going to improve over time, all the time. And I do think that the numbers show that investors and serious investors, right? It's not like we're going after the same clients that Chime is going after or something like this, where we're helping, children get their first bank account. These are high net worth clients that are looking for high interest rates, and we're able to give them that, as well as a slew of other products. And, from the numbers I showed you, from the growth in the products, from the growth in the members, we are absolutely nailing it.
I was going to ask this question, and it's, what is the numerical explanation, like the one or two metrics that you hold on to when you say the statement, I cannot justify a $4 billion valuation right now, which obviously means to buy? Like, what is that that thorn sticking out that says this is stupid at being at $4 billion?
I'd probably say between revenue to market cap, probably.
Yeah.
So just price to sales that's it?
I don't think so. I don't like price to sales that much. I'd say probably price to book. Because if we're going to get acquired, that's always the problem with people saying that this stock can keep going down. It's like, eventually JP Morgan's going to scoop us up just for our assets under management. Like, eventually we're just going to get bought up because of our systems that we have, because of Galileo and Technisys. So that, I think, is the thing where I'm like, we're worth more than $4 billion flat. So, and actually today we're not even $4 billion. I think we're less than that. So that's really the metric that I hold on to, where I go, are we not counting any growth at SoFi as if we're not going to see 60% more year over year members? Like, at some point you have to also include how much we're supposed to be growing that earnings. The fact that we are going to profitability closer and closer every single quarter, right? We will break profitability. It will be a company that's worth growing. And at that point, if the valuation stays depressed, there will be investors to come in, and not only a single buyer, right? Because like anything, whenever a buyer comes in and wants to purchase the company or a partial bit of the company, more people flock in because they think that someone else has seen value that they don't. And so that is the stock market, right? Like, we're all hoping someone buys this company out in full. And if you're not going to buy it in full, you buy it out partially and hope that someone buys out your shares. That's it. And then also there's the fact that SoFi, let's say if the stock just stays depressed, it's the, Citigroup of the finance world, even though we have, much more growth. But let's say it's the Citigroup of finance. No one really likes the company and it just stays depressed. Well, then it's a dividend play, and but after profitability, we will be a dividend stock. We will be doing buybacks. And I guarantee you there will be value investors that scoffed at us then that will love us now. That's not what's keeping the stock down. Obviously, no investor is dumb enough to think that our growth rates aren't great. It's the survivability. It's, are we even going to make it there? There's people like Jamie Dimon and these sorts of things that are writing articles and coming out saying that they think there's going to be massive layoffs. That's what's scaring investors. It's safer to put your money in other stocks right now, but that won't be, forever. And I'm not a good enough investor to time that market. And I would say Warren Buffett would probably say he's not, the best at timing the market either. He looks at the stock, looks at the price, and thinks whether it's undervalued or not, and that's when he buys.
Yeah, so two things, right? If we want to detach the emotions from it, and we can chalk a lot of the actions up over the past year or even 2 years more accurately, that it's been emotion, right? It's been euphoria and pandemonia. It's been fear and greed, respectively. And if we want to just remove that and say, hey, look, the Nasdaq's down 34% year to date, SoFi's down, over 70% year to date. A lot of that is going to be emotion. Going forward into 2023, if you think logically about it from a numbers-based, sort of rational perspective, you say, well, look, the more it's fallen, the less likely it is to fall more, because you go into that book value sort of method evaluation to say, hey, look, this company is actually worth something. They're actually producing, they're actually growing, so on and so forth. Therefore, if it's fallen to 4, can it fall to 2? Yes, but it's unlikely. Can it fall to 1 from 2? Yes, but it's even more unlikely, so on and so forth. And then you've got to go into this idea of saying, what is the risk reward that I get? Can SoFi fail along the way and not make it? Absolutely, they can. But at this number, at $4 or at $3 or at wherever we land, the risk to reward ratio for you investing that money is in your favor, because there's minimal fat on it. And so you're trading at book or under book value. There's no bloat on that investment at all. It hasn't been hyped up as though you were investing in 2021. And so that's all we're saying. It's like, well, if we take the emotions out of the game, then what is the relative risk to reward ratio for you putting $100 in SoFi? If it goes bankrupt, you lose that $100. But if it doesn't go bankrupt, what can you make? And at this price, you can make a whole bunch more, because the market is basically giving you a huge discount for you to buy it.
Okay, a couple things here. First, the comment by VR Vitali. Thank you for being here. Not how this works. The more it's fallen, the more it can fall, not less. I think we all acknowledge that, Vitali. I mean, that's why Tevis literally just said 4 or 3 or 2. I think there's just an argument that at some level it gets to a point where more and more people realize that it is close to a bottom. This is kind of the whole thesis for why Tesla potentially might have hit a bottom, or might.
But I would just say that statement was also just fundamentally wrong. I mean, maybe I read it wrong, but the more it has fallen, the more it can fall. That's wrong. I mean, the more it comes up, the more it can fall.
Yeah.
The more that the valuation is overvalued.
Yeah, Vitali, that was a stupid thing to say, Vitali. That was just dumb. I can say that because Vitali's my friend, guys, by the way.
But, I mean, it is wrong though. Like the more it's fallen, the less chance it has to fall. The more
it's not like it can't fall. Right. It
can fall, but it is actually less of a chance to fall because it has fallen. So
let's look at this comment. The thought process is lacking nuance. Thank you for that compliment, Capital Mindset. Such a friendly way of addressing the chat. Thank you so much. That was great. And no, the book is not a sign of how undervalued it is. So we know the tone in that comment. But can we talk a little bit about the price to book value? What is the counter argument for why it is a sign of undervaluation?
Sorry?
His comment is price to book is not a good sign of how undervalued a company is.
Okay, well, if we have a positive book ratio, more assets than liabilities, then we can use those assets to pay back our debtors, and then the net amount of assets you can sell to investors, and that's called money. So if you can get a company for less than book value, then that's profit.
So
yeah, man. I mean, I think a lot of people try to. I'm not going to say some things I was going to say.
No, I'm down to break it down back to let's go back to.
I think a lot of people just want to be dicks. Is what I think a lot of people just want to be dicks and they want to say certain things. But like that's you can argue price to book is not the best metric of how undervalued something is. But to say it is not a metric or it's not a sign at a $4 billion market cap when the stock is 80% down of how undervalued a company can be when they're going to bring in $1.52 billion in revenue, even if they're not profitable. That's just So I don't know. That doesn't make sense.
I want to just go back to a comment that Vitali said. If you scroll up a bit, Amit, he had this comment saying the bottom is 0. And I think, guys, we need to establish a baseline on something. The bottom for any stock is 0. Apple, the bottom is 0. Like, you can make that argument for anything in the market. What we're saying
Enphase,
is
the bottom is 0.
sure. What we're saying is, like, there has to be some part of a rational argument that goes into play. And absolutely, I'm not advocating to use one single metric or even a handful of metrics. Like, you have to make an assessment based on many different factors that go into it. But there has to be some thought process as to what is a realistic bottom that is not 0. Because if you say the bottom is 0, then it's a binary event. It either goes bankrupt or it doesn't go bankrupt. And then you have to say, well, what is, again, going back to my original point, that risk to reward ratio, if it does or if it doesn't. Like, let's say it's 50-50. This just, whatever. Let's say it's 50-50. 50%, you lose all your money. 50%, you might make 5x or 10x. That's a good risk to reward ratio if you think of it in those extreme drastic terms, if the bottom is 0. But if you're saying that, Apple or whatnot, like a company that is profitable, that is not like Sofi, because I understand the case for Sofi being unprofitable. Therefore, they have a burn rate that when they get to a certain point, they have to raise more money, and that's the risk involved. But when you say a company that is profitable, bottom is 0, then you're removing all that, like, rational argument out of it. Like, the valuation
Yeah,
doesn't really, yeah.
I think what Tannor was saying about probability, it doesn't make sense. If a stock has gone to 4, it is not more likely to go down from 3 if it was at 5, because it has more room to fall. Like, literally, like, so it could go down, but that doesn't mean it's more likely, unless there's some catalyst that none of us know about that we're not factoring into a hypothetical that could push it even more.
Well, yeah, so you kind of have to, weigh what the chances of a total collapse in the stock versus, them continuing to grow 60%. And now it's not always a great sign to just look back at previous records. For example, let me throw out a wild idea. Okay. And I mean, the more and more I play with ChatGPT, the less it becomes a wild idea. But let's say that ChatGPT is such a great product that OpenAI can, throw out a product that is a competitor to Google. Okay. Because Google has been such an amazing company before, does not necessarily mean that the growth will continue just because we saw it previously. ChatGPT could bring their growth, into the negatives, and then going forward, people are using the search engine less and less and less because there might be a greater alternative. So that's why we also try to look at SoFi in a way of who's our competitors. Would you rather go over to them or to us? So we look at the interest rates, we look at the product diversification, we look at, these sorts of things. And now we're not great on the user interface thing. I think as a brokerage, I'd prefer Robinhood. I'm a Canadian. I don't use either. But I'd probably prefer Robinhood than SoFi. I mean, there's a couple people that'll say, oh, well, I don't want my screen flashing red. I want a fast app. I don't care about that. You know what I mean? I can get over the fact that my screen goes red. So, these sorts of things. But we are looking at that in every sort of way. Our credit card is extremely, extremely competitive. Our personal loans are very competitive. You're looking at that and how fast they're growing. Whether or not you want to say that the people won't buy that product, they are buying it, and they're buying it at a faster rate than ever. So people love the personal loan product that SoFi has to offer. Our time to actually fund that loan is same day. It's getting insane. So, there's a lot of great things with SoFi's actual products that I also think, like, the growth is going to continue to continue, obviously, because I think that the total addressable market is increasing. We're increasing to new countries that we weren't in before, where the total addressable market of people who are using digital cash or digital currency versus cash, and I don't mean cryptocurrencies, I mean, like, online payments, I think is also increasing. And all of those are tailwinds for our business. Now, we do have a very big headwind, but are we going to get through it? Are we way undervalued and it's already priced in? That's very interesting as well. That's what I think is important.
I agree. Someone says, how does the banking side, fundamentals, student loans, private loans, mortgages compare to other similar banks? We would be worse compared to other banks, but that's just because we're much smaller, I'm assuming.
Well, in terms of growth rate per product, like this is another thing too, which I don't like some people whenever they say, like, oh, I prefer to own, this stock that's growing at 0% versus this stock that's growing at, 60%, but it's riskier. It's like, yeah, but the you're buying on the what's the percentage of chance? What are people betting on the upside of the company, right? This is like Tesla at its heyday. It was all euphoria, 100% chance of success. Stock went into the trillion, the $1 trillion market caps. Optimus robot's going to be great, all these sorts of things. And then you start to actually price in, you see this robot on stage and you're like, okay, well, that doesn't look like it's ready to be in my house yet. And then people start to get a little bit less, excited. The actual total, car space, they're losing the demand and everything like this. I mean, I'm talking about a different stock, but, things can change about the optimism about a company. What I think is important is that we're looking at this stock on a day-to-day basis, but the information that we're getting from the stock is not day-to-day. We're only getting it quarterly. And every single quarter, don't forget, these were our expectations. Analyst expectations were lower than what actually came out. That means we were getting triple beats, which is what it was, quarter over quarter over quarter. Meaning, here's your expectations, we beat it. Here's your expectations, we beat it. Here's your expectation. You get the picture, right? So, if you're actually looking forward, like I said again, what is the likelihood that we are going to beat it? What are the signs showing that next quarter we are going to miss on revenue? We're going to miss on member growth. We're going to miss on these things. I don't see them.
Yeah, I think we triple beat every single quarter so far this year, or at least on a trailing 12-month basis we have.
Yeah, or met. We've never missed. We've never ever missed.
Has there been any product or metric that hasn't grown at a substantial rate? I mean, I looked in your chart; it was pretty much all triple digits across most products.
Yeah,
the lending products.
Yeah, student loans didn't do well. That's pretty much it. Here, let me just show you it again really quick. I don't know why I can't zoom. Oh, maybe that's too much. Yeah, so that's the products from that entire thing. I have, every single quarter here, so we can go through and look at every single quarter of growth. I could probably make that smaller, or maybe this is for another day, but it has been very, very substantial. I want to get rid of that now, but yeah, so we are growing in all these products. This is the base of our company. It's why it's the first slide on our pitch deck, right? It's where's our monetizable users, and is that even a metric? Like, banks are not growing in deposits. We are growing and taking total market share in deposits and these sorts of things, which is a great metric to show off monthly active users, because where you're using your direct deposit is most likely your primary bank, right? Primary banks make 10x the money than a bank that's just looking for, I don't know, for you to use one of their products, which is a case that can definitely happen. I bank with a lot of banks just for their credit card and these sorts of things. But, what I like a lot about SoFi, and what Anthony Noto's even seeing too, and maybe we should bring that back up, is the amount of purchases that he's making. Unlike, everyone goes Asana, right? That's the company that Dustin Moskovitz, I can't say his name, that he owns. The guy has like $11 billion, for him to purchase a $1 billion or $1 million share in his company is not the biggest sign as to Anthony Noto pouring like a quarter of his entire net worth into one company. You think he's throwing that into a shit co? Sorry about that. Maybe I should bleep myself out, but
that's so cool. That's dope.
Yeah. So I don't know. Yeah, it's also funny too, if I could speak on this really quick, is just the idea of whenever Tesla is at an all-time high and you're even seeing a bunch of new investors that didn't make any money on Tesla and everything like this, Elon Musk is the cat's pajamas, That's another old saying. So we can add that to the list. Everyone's excited whenever everyone's making money. And then whenever the stock is going down, these are your worst enemies. Change out the CEO, do all these things, even though, we're going exactly where the fintech market is going as well. We're not underperforming in terms of our competitors at all. So I don't know. I'd love to hear what you guys have to say.
I'm just looking at the chat. There's like a lot of back and forth around like buyout conversations. And that's like a tantalizing topic to talk about. just because it goes along with like a lot of the arguments that we're making with the stock being as cheap as it is. Institutions are also seeing that as well, and a lot of these big financial institutions are big holders of SoFi as well. And it's definitely something that for 2023, maybe we want to jump into Bender's points. A lot of those are sort of product focused, but there is a possibility, I would say a heightened possibility of a buyout in 2023 relative to 2022, as in there's more of a chance because we're down 80% on our valuation since 2020.
That's the same in any sort of depressed market. In a bear market, it's merger and acquisition, baby. Like it's time to scoop up the people that were undersold, right?
Yeah.
And if you did buy during IPO time, that sucks. It does. If you're buying today, that's not a bad thing. Well, not if it happens further down the line, if we're at like $2 a share or whatever. But if today we get a buyout offer, the people who bought today are going to be very, very happy campers. I guarantee you that. And stocks don't get bought out for the price that they are. There has to be a large premium for that purchase for everyone to sign off on it, for the board of directors to say, okay, as a fiduciary duty, this is the good thing to do for our company. But there's also an argument to be made for Anthony Noto and the board of directors to say, you know what, we were overpriced whenever we first came out. We're underpriced now. And actually, we decline these sorts of offers. We've been, we've had a buyout offer way back in like 2017, I think I remember, for $6 billion, more than we are today. Back in 2017, think of the growth rates that I just showed you guys for 2 years ago. Imagine 5 years ago, when we didn't even have a financial services segment, whenever we were just a student loan company, for $6 billion before the pandemic, before all those valuations.
And who offered that?
I think it was an Indian company. I'm really on memory here, so I'll try to find the article for you guys. Maybe I can tweet it out afterwards. So make sure you guys are following me.
That's a good plug. It's a good plug. Oh, I think I found it right. It's well, I found the article. It's just loading. It's from oh, it says Schwab tried to buy them.
I mean, this is only a rumor, so it's unsubstantiated, but I think there was a rumor at some point in 2021 or early like 2020 that Goldman tried to also make an offer for something like 9 or 10 billion. But I think that Noto's stance has been pretty clear on the buyout, where he just feels that the inherent value of the ecosystem is much more than anybody would pay today. I mean, I think a buyout today, something like 15 billion wouldn't be out of the question, which is like, a 3x or 4x, depending on, where we end up from these levels. But I don't know that Anthony Noto would take that. I don't think he would, quite frankly. But it would probably be one of the bigger banks. Like it would probably like JP Morgan or Goldman would probably be my guess, especially because Noto also has the Goldman connection there as well.
Right. We only have a little bit of time left. I'd like to take 2 more topics just really quickly. I'd like to talk about insider buying really quick. And then let's talk about, Bender 9000's future predictions. I'll just do this really quick. I'm making a future video. It's going to be on the market effects of insider buying, like market wide. Okay. Whenever insiders, directors of the company, high up directors start buying the companies, it's a okay metric to know that we are at the bottom of the market. And I'll show you guys sources, but you'll have to check out my video for that. But whenever we're actually talking about, whenever we're talking about top executives, CFO, CEO, purchasing companies over and over, there are metrics globally, okay, showing that as we start to see increases of insider buying globally, that these are like some of the highest metrics for spotting the bottom of the market. It's why people pay attention to insider buying, especially with the people that know most about the companies. Now, I will show you guys, like I said, but you guys should look at Market Beat and actually find out insider buying that's happening across the board. December is a massive month for CEOs, CFOs across the board buying companies, okay? And now, I think hopefully if we keep staying depressed, maybe January, February, it even increases even more. Oh, lost a minute.
I'm here. I'm here. The camera just changed. I'm here. I'm here.
Got you. Okay. But yeah, very, very exciting. I want to talk about that more. But Noto is ahead of the game in the way that he is buying this company, and like crazy, a lot of money is going into this company. I think that paints a bigger picture than people give it credit for. Let's jump into just the last topic of the day, and an exciting one. Bender's, predictions for 2023. Hopefully he gets 70% of them right again. Boom. You guys got me?
We got you.
All right. This is Bender 9000, the 23 potential catalysts for SoFi in 2023. Big wins for the tech platform. He talks about, getting large financial institutions as clients. What do you guys think about that?
I mean,
you think it's a possibility?
He mentioned that it's a city conference as well. That like that quote from November is in the city conference where he's basically like, "Hey, we have some people that we're talking to." I think the main thing right now is that the way that Noto is seeing it, it's a matter of when, not if, for these big legacy players.
Yeah. Galileo products. Now, these are the products that we've recently released. Direct deposit switch, pay in 4, fleet cards, dispute APIs, enhancements in the payment risk platform. I think that's with DataVisor, leading partner that we have for risk management. The upcoming products that Bender believes are coming, and this is in the roadmap: rewards programs, credit card programs, lantern style referrals. It's like insurance and loans. All massive products. So if this gets launched, this is bigger than we think. I mean, rewards could be massive if that's launched, for example, in the same way that Robinhood, one of our clients, if they do a rewards program, that could be absolutely massive for their type of audience, right? A younger audience, sort of build points. You can buy stocks with those points, use the card more. And then in the end, that comes back to SoFi because, those are our clients through their cash card. Anything on that, guys?
Yeah, I kind of want to circle back to that rewards point as well, because again, I think it links into the ecosystem of the cross-selling with the shopping side as well, which was another one of the suggestions. Basically, the idea is that they're going to have a wide diversification in the benefits of you being a direct deposit member or a SoFi Plus member in terms of what you can do with those, like what perks are available to you. And a lot of them will be B2B powered by Galileo, but as more and more are introduced from Galileo, like we saw with Buy Now, Pay Later, 2 weeks later, it becomes B2C SoFi branded content.
Right. And
I was just gonna say the Galileo products launching is one of the biggest reasons I'm excited, because that's why I invested in this company. So it'll be really cool to see them make progress. Yep.
Right. And maybe we'll you have Palantir tonight at 11?
11 to 5. Yep. We got a couple minutes.
Okay. I'll just do one more then. Maybe we can get this on next week, so you guys will have to come back. But lending segment. SoFi writes their own loans. They match addition. Actually, this is not a great. I don't want to. This doesn't really spark a lot of conversation. Retail CDs. How about this one? This is a great one. I love this. SoFi brokered CDs are a big hit. Brokered CDs help diversify funding, and retail CDs have a low cost of capital. Members are interested. Look for SoFi to directly offer retail CDs. I bet you there is a lot of people in the chat right now who have CDs, and it's a great product, especially in this market. SoFi doesn't offer it right now. That could be absolutely amazing. I think that we kind of really need that to be a one-stop shop.
Yeah. That would be interesting if they actually offer retail CDs. What's the percentage chance you put on that?
I mean, nearly 100. Now that we're a bank, it's a great product. Everyone wants it. And I'm sure it's not that hard to implement considering some of the other products that we offer. Here, let me drop this for a sec. I think people forget how fast to innovate SoFi was, especially during the pandemic. That's no difference. We're just dealing with a lot bigger challenges. And I'll leave it there. Yeah, hopefully you guys have something to say.
Yeah, all I have to say just to wrap my segment up is like, I made a similarly, to a lot of the charts that Tannor put up, I did, some introspection on what did 2022 bring for SoFi, and I just summarized it all into this big Twitter thread. And I would suggest
Good thread.
that if you're interested, take a look at it, because it will help you, like, not even for the individual points themselves, but just looking holistically, it will help you understand the rate of innovation at this company and the rate of new product introductions and how they're thinking about this whole ecosystem effect. It's very, difficult when the entire sort of stock is down over 70%. But when you see that every single month there is 1, 2, 3, new products that are launching consistently every single month, then you start to decouple those ideas of saying, well, this is a stock that's down 70%. I'm very emotional about it, with this is a company that's consistently executing and innovating, and I should be very excited about it. So that's all I sort of have to say. And I think that, similarly in 2023, we can see, something for like similar rate of innovation or rate of new product launches, if not accelerated in 2023, because these things happen exponentially.
I love it. I love it, guys. Amit, do you want to wrap it up?
I was going to just say thank you all for joining us on this journey. We started, I think, late October, and it's been an awesome couple months. I'm about to do Palantir Weekly. We're going on episode 45, damn near like 50 weeks, which is almost the whole year. So it's going to be awesome for SoFi to at the end of next year to see we've been doing it for that long. And we'll see how it turns out. So thank you everybody for joining. Appreciate the chat. 154
Happy
people
New
here.
Year.
Happy New Year. Please check out all the links in the description. Tevis, Tannor, all the YouTube channels, Twitters are there. We'll see you guys next year.
Check out my videos. Bye.
See y'all.
You got to use that more, bro. That's so awesome. That's great. Bye, everybody.